Hello, I'm Jessica Amir for the Finance News Network. With me today from Russell Investments is Director Client Investment Strategies, Scott Fletcher. Scott, thanks for coming and welcome to the network.
Thanks, Jessica.
So first up, we've seen a lot of volatility in the markets of late. What is it really saying about where we're at and where do you think we'll be headed?
Well, there's no doubt that the markets have taken investors for quite a wild ride in 2018. But I think we really need to look at this wild ride in the context of the broader picture, which is we've had 7 years since the Eurozone crisis of 2011, 7 years of very strong, solid returns. So investors have actually done pretty well. What we're seeing at the end of all that is we've seen asset markets, particularly in the United States stock market, push to valuation levels that are very expensive. And so the volatility that we're currently experiencing is very much in the context of a late cycle, momentum-driven transition phase in the market. So we're late cycle, we're looking out towards the risk of a US recession, 2020, for example. And so there's a lot more volatility creeping into the market, which we will think will usher in a lower return, higher volatility phase, probably over the next few years, the medium term. That creates a significant investment challenge, in fact, looking out for those investors requiring a growth-like return, say CPI plus 4 and so on. Thanks,
Scott. So what can investors do to really navigate through this investment challenge?
Well, the nature of the investment challenge is probably helped by thinking of some numbers. So if we look out 5 years and we put in capital market assumptions of markets that have been pretty successful over the last 7 years, for example, high valuations means that you've got less upside. So when we put those capital market assumptions into building a portfolio for the next 5 years, we end up not at CPI plus 4, which is your typical 70% growth, 30% defensive type portfolio that a lot of investors have. We end up about 2% short over the next 5 years. So really the critical success factors for bridging that gap come down to a combination of additional sources of return, extra asset classes, even in traditional asset classes, the processes or styles that you can invest in to generate that return. Also dynamic management. Dynamic management really means what are you going to do to adjust your market risk through the cycle? That's a big one. Downside limitation strategies, use of options and so on. And of course, every time you move money, and particularly in a lower return environment, it costs money to move money. So you need to be really efficient in your implementation. Now, most investors in a retail sense can only do really one of those 4 things in any way, shape or form, and that is in terms of diversification, but it's not enough, we believe. So effectively, that's why we've been seeing increased interest in our dynamic real return solutions.
And Scott, so you mentioned an increasing number of investors are looking for those real return solutions. Maybe you can tell us about the Russell Investment Real Return Series and how it's being used.
Sure. So the Russell Investments Real Return Series is effectively 3 funds. There's a flagship fund, our multi-asset growth strategy, which targets a CPI or inflation plus 4%. But unlike a traditional balanced fund or a conventional balanced fund, it is very targeted to the return outcome. And not just the return outcome, but it also has objectives in sense of volatility, how much drawdown, is a much higher drawdown focus in these type of funds. And also in terms of income focus, there's a part of the series which is our multi-asset income strategy, which also has a more conservative asset allocation and a bit more of an income focus, more conservative end of the spectrum. So these funds are effectively a different animal to your conventional 70-30 fund, and they're very much designed for people with a higher sensitivity to downside. For example, people close to retirement, pre-retirees, early retirees, they can't afford the capital hit, but they still may be underfunded and they need that sort of growth style return, but with less volatility. So it's the same destination, but just a different journey, and that's the big difference in these funds.
Thanks, Scott. And for investors thinking about going into a real return fund, how does your fund differ from others in the market?
Yeah, it's an interesting question. So when you move around the market and you talk to different investors and advisors and so on, and even in the institutional side, people try to put a blanket over real return funds as though they're all the same thing, and they're not. It's a very broad church, a very wide range of different ways of doing it. So one of the main differences in terms of the way we do it at Russell is we look at those critical success factors to bridge that return gap that I mentioned earlier, and we build those sort of critical success factors into the design and the structure and the management of the fund. So effectively, dynamic management, all about how do you adjust risk through the cycle, is critically important and actually makes the biggest difference. So when things are going well and the market's going up, it's obviously keep pace with inflation +4. When the markets start to enter this volatile sort of transition phase and then move to bear market, it moves to capital protection, capital preservation, if I can put it that way. So dynamic management, the way you systematically adjust the growth exposure or the equity market exposure through the cycle is critically important. A lot of other funds out there were pretty much designed in a very large bond bull market and have quite conservative allocations. So the main thing to look for in real return funds is how, or do they actually significantly adjust the equity market exposure through time? And you have to be systematic in the way you do that. Loading up on growth exposure when things are cheap early in the cycle, and de-risking as the cycle matures to make sure that you're pre-positioned for the downturn.
Scott Fletcher, thank you so much for your insights.
My pleasure, Jessica.